Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the great potential that options give you, and I'm going to show you how to convert a trade into a free trade. So here's the kind of the setup. So this is the QQQ, and yesterday, the 23rd of September, you can see that we had this swing low right here on the 21st. That was Monday. And then on the QQQ, we had a retracement up to the 50 simple moving average right here, about 273. So typically what you have is what I call a retracement failure a lot of times when you have a big sell-off and then you get a retracement, reversion to the mean, which the 50 simple moving average is a good one, and then it loses momentum and sells back off. So you can see right here, we were looking for this potential setup yesterday on the 23rd right here. So the 26th or 22nd, we had that high right there. So if you look over here to the 30-minute time frame, then what we were looking for about 272 right here, we saw the momentum start to shift down, cycle 1 and 2. This are momentum indicators, and so you can see the market failed here. So we got back up to that 50 simple moving average right here at 273 right here, see that? And then the market started to stall. Momentum started going down, so you can see these histograms, negative momentum. So at that point in time, it was a perfect setup to go short. So the original trade, what we did yesterday on the 23rd, we went short on this break of the 268, looking for this prior close here, 266, which was the prior week's close. If that got taken out, then we'd have a bigger move down. So we started the trade off with a put debit spread, and then we were looking for a flush down. We were looking for a potential target down to 260, and then take it from there. So this is how you can convert and create a free trade where you have zero risk to play more downside in this occasion. So if you look here at the trade here, I'm just going to fast forward here a bit. You can see what happened. We had that break of the 268, and then the market dropped pretty hard yesterday going into the close. So let me show you the trade setup, how you would adjust this and convert it to a free trade. And so what we did, we converted it from a put debit spread to a put butterfly with zero risk. So let's take a look. So the original trade right here on the 23rd, when we started breaking this 268 level, we set up a put debit spread for Friday's expiration this week, the 25th September. So bought the 266 put, sold the 262. All right, so $4 wide spread, and got into that at $1.01, so $101 at max risk per spread. So the potential max profit would be at expiration on Friday would be $299. Pretty nice positive risk reward. But as it flushes down, this strategy is to adjust it. You take profit, you take some profit here, and then if you want to do a free trade, you can get into this by converting it to a butterfly if you can capture the credit of the debit you paid. So we paid out $1.01. Now if we can capture a $1.01 credit, we've got a free trade. So yesterday when it flushed down here to the lows right around 263, this credit spread, the 262 258, which is the same short strike as the put debit spread, this was going for about $1.20. By the time we set this up, we got into this for a bull put credit spread at $1.01. Okay, so we have $1.01 credit here, and that then offsets the debit cost that we had from the original put debit spread. Okay, so here it is. The original put debit spread, we paid $1.01. We sold the bull put credit spreads, sharing the same short strike of the 262 from the put debit spread, brought in $1.01. Now we have zero risk. Okay, so if the market was to go straight up, we'd have zero risk. If it cratered straight down, we have zero risk, and we could trade the trade and keep the trade into Friday and potentially have a huge payoff. So for example, right now today with zero risk in the trade, we had an open here. We had an opening low down here at about that low is about 261. Okay, so at that point in time, this trade today was up $90 on zero risk. Now the other great thing is if we tomorrow coming in on Friday, if it's trading down here at 260 or 262, let's take a look at what you would get on this trade with zero risk. So we have zero risk to the upside or downside. All we can do is sit here and see what happens if we want to wait for the expiration tomorrow. And if we get a big flush down, I'll show you what this would look like. So I put my analytics here on this date, the 25th of September, and let's say tomorrow we get a flush down here and it trades back down to these lows of today. Let's just say 262. So tomorrow on the open, if it trades down to 262, this trade would be up $125 per spread. So if you did one spread, that's $125. If you did 10, that's $1,250. But if it goes out at tomorrow at expiration towards the close or into the close at say 262, this trade will be up $385 per spread. So it's a great strategy to use for options. You could do it either converting it to a free trade of a butterfly or a condor. So if you'd like to learn more about these trading strategies, please come visit me at PowerCycleTrading.com and use the link on this email and sign up for our free webinar courses, and I'll be having a free one this Saturday. Hopefully I'll see you there. Good luck trading.